Hey, thanks for tuning in for today. Today is our open office hours call, so we had a couple of questions that came in. If you don't know me, my name is Victor Bell because I think we're going to be posting this one, sharing this recording on our YouTube channel. So my name is Victor Bell. I've done over $59 million in real estate deals. I'm the founder, creator of Bell Capital, which is our real estate fund. And my background again goes back into I've been doing real estate for 20 plus years. But technically, my unfair advantage has been the fact that when I got started in real estate, my first business partner was really in finance. They owned the Success Mortgage Investments, which was a finance mortgage company that did deal structuring and buying notes, um, private lending, hard money lending. A lot of the deal structure and creation that I did was really a finance game, not necessarily a real estate game. I wasn't learning construction and cost and things like that. I was learning how to put together DSCR, yields, spreads, how the money actually worked, LTVs, and putting together partnerships and naturally, putting together the structure of the deal to finance. So I kind of have this background in this thing towards I really understand multifamily real estate because my first portfolio was multifamily real estate that I put together and brought to them as my financial partners. And then I started really working inside of the company and seeing how the sausage is made. So a couple of questions, and I'll get right into it that we did get. One of them was how exactly do passive investors make money in real estate through investing? And I'm going to do this because I want to write it down rather than me go through and have our team put in a bunch of stuff and PowerPoints. I'm not always a PowerPoint guy, but I wanted to go through this. That's a great question. So thank you for asking that. So, question repeated. How exactly do passive investors really make money in real estate deal investing passively? So, number one way, and I brought this out, I'll do this. Number one way that passive investors make money, passive INV, basically make money. Great question. So, number one way. And I start off with this. Few people start off with it, but I think it is a way, like Warren Buffett says, don't lose money. So if you don't lose what you have, then that's also another form of making it. So number one way that passive investors make money in real estate, millions of dollars in passively investing in real estate is through capital preservation. That's CP, capital preservation, preserving your capital. So if you take your money out of the bank that was cash and you convert that cash while it's going down in value into a real asset, a hard asset that has value, that is also how passive investors make money because you don't lose that capital, right? Your investable capital. So that's number one. Number one. Number two is through appreciation, right? And there's a distinction that's controlled appreciation. Probably spelled wrong. But controlled appreciation, meaning that we can control the appreciation as we increase the income of the property, the rents, whether that's increase the rents, other income, things like that. The value of the asset goes up. So we can actually control the appreciation, unlike in stocks where you can't do that. Passive investors that invest passively in a real estate deal. Now I'm talking about commercial multifamily real estate that we look at, institutional quality, meaning size and scale. That's where you can control the appreciation over long periods of time. And that's expected when you're a passive investor to be able to do that. Number three, naturally, is passive income, right? Or like we like to call it, cash flow. Everybody loves cash flow. Everyone needs more cash flow. Like even if you have hundreds of millions of dollars and you get a check that comes in every month, whether it's 200, 2,000, 5,000, whatever, it feels good, man. You start to pay attention, right? Right. We've all heard it. When you pay attention. And what pays you, you pay attention to it, right? Money follows attention. So naturally the passive income coming from that deal is also how passive investors get money, which hence the word passive, right? You didn't have to go off and work harder than you already do in your business or your job or your life while you're running your business and also running your family. All right, so number four way that passive investors get paid in this deal is through tax benefits, right? Tax benefits. That could be through depreciation, which there's cost segregation, accelerated depreciation. Real estate has depreciation, so you can invest as a passive investor, and because you're a partner, you get passed through tax benefits that go to you that offset your passive income. And some of them, if you qualify as like a real estate professional or a family member, your wife, spouse, husband, they want to file as a real estate professional, then you could also offset some of your other income, your working income through those things too, because it's a pass-through tax benefit. If you're doing it yourself, which is now not passive, there's other ways to do that through 1031 exchange, depreciation. If you're not going to accelerate it fast within the first couple of years, you can still accelerate investing in real estate through over 27 years. It still doesn't matter. So all of these things are a bit of ways that passive investors actually make money in the deal. There's more, but these are the ones I tend to focus on. Number one, don't lose money in our deals. Number two, the appreciation. Could we control appreciation? Could we raise rents? Now, I'm not talking about forcefully going in and raising rents and fixing stuff. That's not what we do. But what I do like to understand is if inflation will give us a natural lift in rents, right? There's not a lot of affordable rent in this country. Developers not building $2,000 a month rents in California or $2,700 a month rents. It just physically, I mean, financially, they just don't pencil if you're a developer. So knowing that, we try to look for things that are 2,900, 2,700, 3,000, 3,200 because we know in 10 years those rents are probably going to double. That's usually a basic math that I look at for rents. Rents tend to double every 10 years. So that means that the value of my property is going to continue to have a controlled appreciation over time. And next, that passive income or cash flow. Now, when I say cash flow, I'm talking about the income that comes in, it covers the expenses and the debt, and it pays us as investors. That's the passive income or passive cash flow, which is positive cash flow. And then last but not least, the tax benefits. So those are just four ways. There's more, but those are the four ways that our investors actually make money. And I'll go over those on a couple because one of the other questions that came in from someone actually kind of overlaps the answer to that. So, um, great. So thanks for that question. So the next question is, what makes investing in passive in private real estate different from doing it myself? Great question, because I get a lot of people ask me, why don't I just do this myself? You can. Here's the deal. I don't know if you guys have ever heard of the three T's. T, T, right? So that is tenants, toilets, and termites. Those are the things that you deal with when you're investing and you're doing your own stuff. So like I've done my own stuff for a long time. I only just started raising money from the public from my audience online a couple of years ago. So before that, it was just me going off finding the deals, raising money with me and a few people, business partners, friends that I had, and I was doing all that work. So I know what it means, especially in multifamily. So you're going to get the calls at night, toilets back up, plumbing problems, parking lot problems, people parking in the wrong spot. What else? Because we started our own little management company to oversee the portfolios. I did. So I put together the management company. We got all the softwares, rent managers, the administrative person to be able to do this, a property management, I'm sorry, the maintenance team that goes out to all the units to turn units when people move out, getting on the phone with the bankers every quarter because they want a quarterly report for performance and find out how things are going based on expenses, based on operations. What do we see happening? Blah, blah, blah. Because your bank is your partner. So by all means, you can do this yourself. You can find the deals, fund the deals, manage the management company, exit the deals. Oh, by the way, when you sell a property, because we sold some of our multifamily properties in the partnership because I was the operator and my financial partner, my money partner, equity partner was not there. I was still dealing with management changeover a month after we had already sold. Because again, I oversaw the project. So because I put together the management team and oversaw the management team, I was still answering questions, or my management team was still answering questions about management changeover. That does happen. So don't just think that when you do this, it's just a hands-off deal. So you want to handle the tennis, toilets, and termites, the management, the late night phone calls, the follow-ups, dealing with the banks, the bankers, your investors, reportings, filing the taxes. By all means, go do that. But you do it with somebody like myself, at Bell Capital, we handle all that. We find the deals, fund the deals, manage the deals, the tax reporting, get all that stuff to you. It's all put together nicely. Overseeing the administrative component of the fund, the taxes, all the tax forms that need to be done, put into our investor portal so you can download those things, do the monthly phone calls, following up with you guys. Like That's the difference of having a professional or somebody that's a professional that has experience understand all of these things instead of just doing it yourself. Like you can do it by all means, but the fastest way to become an investor is to invest with someone else like myself and then find out what it takes. And then you can kind of, you know, see what you want to see. It's like, you don't, just because you like Subway sandwiches doesn't mean you need to go buy a Subway. You just need to go buy the sandwich, invest the money because you get to see how, you get to have the experience and the benefits of the sandwich instead of needing to own the Subway, right? Sometimes it's not all it's cracked up to be. So that's the answer to that. I hope that made sense for you. But yes, you can do it. But nine times out of 10 in the beginning, you're going to lose money. And if you're running a business, you're running a family, you're hardworking, you work your butt off like I do all the time, you really don't have time for two to three businesses because to be honest with you, investing in multifamily real estate is a business, right? And it warrants your attention. It's not a part-time thing like some people think. All right. Next question. How does real estate help me reduce my taxes compared to stocks and savings accounts? Let's see. Basically, how does real estate measure up versus stocks? Okay, got it. So that's also a great question. How does real estate compare to stocks? Like be able to invest your money that's in your retirement account or a money market account savings into stocks. So here's what I did. I went real estate versus stocks. And thanks for that question. Hopefully, this answers it. So, here's what I did. So, if you take a look at real estate versus stocks, so real estate has cash flow and stocks tend to not have cash flow. It's not a consistent thing where you have dividends and some stocks pay. Apple doesn't pay one, Tesla doesn't pay one, um, Ford doesn't pay one. Who else doesn't pay one? Like uh Alphabet, which is Google, they don't pay a dividend. Like a lot of these companies, Meta doesn't do that. A lot of these companies don't pay a dividend. So yes, you're gonna get the gains of being in a stock, but with cash flow for real estate, it does. It has that, it checks that box. Taxes. Taxes in real estate has the real estate and the tax advantages for real estate seems like the tax code was written for real estate owners. Definitely. You don't get that with your stocks. Let's see what else. We talked about does it preserve capital? Yes, it does. Right. It does preserve your capital because if you put your money in stocks, stocks goes up, stocks goes down. It's not preservation of your money. You're just trading paper for paper or digits in your bank account for digits in the stock market because you don't get a stock certificate as much anymore, right? So you're just buying and you're just trading, especially if you're just trading in and out of stuff. So you may get the lift, but you're definitely not preserving your capital, right? Let's see. What else did I do? Is it scalable? No. Stocks are not scalable. If you buy $1 worth of stock, that stock is worth $1. But if you put $1 into real estate, that real estate with good leverage is now worth $3 in a piece of real estate. It's valued at $3 because of the way leverage is done in real estate. So you get the opportunity to do that. I'm going to write on a separate piece of paper as it relates to real estate versus stocks. I'll keep the headline up here. I'll just write that. Real estate versus stocks. Um, Other than that, let's see what else did I put down over here because I wanted to make sure to not go all over the place. Number one, it's real, right? And this kind of goes along the lines of preserving your capital. If you convert your cash to something real, it usually has more value because it's able to keep up with inflation, right? Real assets are inflationary as well. Stocks are not like that. Stocks, they're not real. You're just trading paper for paper. So that's another thing that has a challenge with that. Let's see. Real estate, you can cash out. You can refinance and cash out without selling. You don't need to sell. Over here with stocks, yes, you need to sell. If you're going to cash out, some people say you can borrow against your stock and things like that. Yeah, you can. But be honest with you, if your stock goes down, you're going to have to replenish whatever it is that you borrow, typically with the bank. Or if I wanted to go borrow money to buy a bunch of, if I went to Wells Fargo and I was like, hey, I want to borrow $1 million to buy $1 million worth of Wells Fargo shares, they're not going to give me a loan to buy their shares, which is crazy, but they will give you a loan to invest and buy real estate. So that's the other piece too. If the bank won't even lend you money to buy their own stock, but they'll lend you money to buy real estate, Why would you take your money that's in the bank and then go buy more stocks and shares? Because that's what they're trading out of. They want to be liquid. So, and here's something that doesn't really feel like a benefit to real estate, but it's an illiquid. Whoa. Saw that? Saw that catch? That's crazy. This is liquid, right? This is liquid. Right. So real estate's illiquid. A lot of people want to be liquid. I don't think that that's a good thing. So if you have an investment and you cannot take your money out, you can't, let's say you have a 300 unit apartment building. I can't easily pick up the phone and go sell because the market's crazy. It takes longer to be able to do that, which means that's good. So if I cannot sell that asset, I can't easily liquidate that asset on the market. It's more of an asset to a lender and or a bank or on my balance sheet or net worth or as a company than it would be stocks and shares. Because yes, while this is liquid and I can cash out, if the valuation goes down because there's panic in the marketplace, that's also a problem because when I sell and I go liquid, I'm gonna have to one, I'm gonna go liquid, I'm gonna lose. Two, I'm gonna go liquid. I'm gonna have to replenish that money through making another investment. And where am I gonna do it? I'm probably gonna have to go into another liquidity situation where I'm buying more stocks and shares because I may not be able to get into an illiquid asset as fast as I would like to. I feel like this is a benefit, guys. So, again, so you have all of the benefits to me. If I were to be like, hey, what's the difference of investing in real estate versus stock? This is one of them. Real estate cash flows, there's tax benefits, you have capital preservation. It's scalable, meaning like I can invest $1 and buy into $3 worth of value. Stock can't do that. Um, it's real, it's a real asset, meaning like there's an address, there's bricks, sticks, glass, all that stuff. There's people that live there. Also, I can refinance without selling. I can go back to the bank and pull that money out. I may have stocks. I may be able to go back to the bank and say, hey, I want to borrow against my stocks. But if my stocks go down, that's a problem. And I'll tell you guys about that later on another video because we had an issue with that with one of my business partners that the bank wanted him to pledge stocks. And he was worried about it because if the value of his stocks went down, he would have to come up with the difference of that money based on the loan that we were getting. So we didn't do it, right? So that's how the banks would play that game. And the real estate's not going to be that way. They're gonna be like, hey, yeah, we'll give you a loan or refinance your money or refinance the debt that you currently have and give you money out of the deal because of the income, the production of that actual asset, right? And then next, real estate's a liquid. That's a plus, not a minus for me. Some people they say, no, I'd rather be liquid. Warren Buffett said it too. I can trade $100 million a day out of in and out of stock, so I can do that, but I can't do that with real estate. But we aren't Warren Buffett. Our goal is what? Not lose money, right? Sorry, right here. Our goal is not lose money. So the liquidity, it being illiquid actually is a benefit on the way up as opposed to the other way around. So let's see. What was the other question that someone had? I'm looking for it. Thanks for this. Oh, okay, yeah. It was another thing about like, okay, cool. So what's the other difference of doing it myself if I have $500,000 to invest? Okay, another great question. So you can do this yourself. Let's say you have $500,000 and this person's question was basically, I have $500,000 to invest, and what's the difference between investing it, doing my own deal, or investing in something like what you have? Got it. So this $500,000 in real estate, if you're going to buy like let's say a multifamily property, you're going to probably buy about let's say $1.5 million deal. So you're going to buy a $1.1 million apartment building, depending on where that is. That could be an 8 unit deal, a 4 unit deal, whatever. But let's just say you did this, you invested $500,000 in a deal, and it got you $1.5 million. Or you invested with us. Let's say you invested with us, right? And let's say you didn't on this one. You just bought a $500,000 piece of real estate. Boom, whether it's a single family house, duplex, fourplex, whatever. But because what I was meaning is if you were to invest with us, like I said, from a leverage standpoint, your $500,000 would get you a $1.5 million position in Bell Capital in one of our deals. All right. This is you by yourself versus us. Now, on this deal, let's say the value of your property went up by 10% over here. You'd make $50,000 on your money. right? Yeah, so if your value went up 50, 10, the value of your property, that $500,000 property that you bought, doing it yourself, hopefully you're tracking. If it went up by 10%, you'd make $50,000 in equity, right? And that's what that would be. But over here, if this went up by 10%, you'd make $150,000 over here. That's three times your that's three times your money that you would have made, a 3%, three times the return on your money, as opposed to just doing one property by yourself and making the same 10% increase of 50,000 versus a 10% increase because of the value of the property has expanded. So that's the difference when I try to. Great question, but hopefully that explains some things, because if you were to be like, yeah, I got 500,000, I'm thinking about buying a deal, I can buy it all cash. Great. Buy it all cash, you get a $500,000 property. It's probably not gonna cash flow the way you would like to, but we're just going off of just valuation, and if the property were to go up in value just by 10%, you make 50 grand. Great. You make $50,000 on your money. If you were to invest with us and that property, let's say that $1.5 million position you bought into goes up by 10% in value, you made $150,000. That's three times what you would have made on your own. So it's a little bit of a different thought process when we're thinking about that, because that's 30% as opposed to 10. Right. And I'll write that there so you see it. That's a 30% plus, right? That's three times what you would have made. So I hope that explains a little bit too, because this is like I was expressing what I learned when I first started. Really, this is a money game. This is about taking your money, your hard-earned money, and investing it in a piece of real estate that, one, it pays you, two, it protects you, three, the value of your asset goes up, so the value of your investment also goes up, right? Without you working for it, and you get the tax benefits of doing that. So you're offsetting what you made, based on the returns that you made from the asset, the prep, cash flow, all that other stuff, and you potentially get to offset some of your other revenue and income, maybe from your company or something like that, because of the write-offs that you have that spill over additionally from your real estate investments. Um, and then last but not least, you can actually invest passively in a deal because you're taking your hard-earned money and you're investing in a professional, institutional quality asset with people who know what they're doing. People like myself, who has, a property management company, Greystar, who's going to be managing the assets that we look at. They have over 120,000 units that they actually manage themselves. So they know this market a lot better than I would ever know it. They have the teams, they have the stuff, they're a part of the underwriting, they're part of the planning process. We're only looking at quality assets. And that's the distinction between investing in like a mom and pop. You don't have to do that. You can actually be a limited partner passive investor in a professional investment, which is what you're supposed to be doing. Like I always said, like I think like an institution, and you should too, as it relates to your investments. This is a long-term game. It's 5 years, 7 years, 10 years, 20 years, whatever the case may be. And I left that off when I was talking about real estate versus stocks. This is generational. You can actually invest your money in a piece of real estate, and then if something were to happen to you, you can continue to have the direction of the revenue for your passive income and all that stuff moved on to your family members long after you're dead and gone. That's how this works. You can not all the time you can do that with your stocks. All right. So I hope today's office hour Q&A really helped you. Thank you for those four questions that we got. I hope I answered them correctly. Feel free to reach out to me directly, if you have more questions. And yeah, join us for next week. If you need anything, let us know. If you're interested in investing with us at Bell Capital, go to bell-capital.com. You can do two things there. You can schedule a call with myself or someone on the team, and we can talk about your personal situation, what you have any questions about the investment, how it works, could you invest via IRA, what are our fees, all of it. We're here for you to answer those questions. That's what we're here for. Or you can, like I said, you can either get started, or you can schedule a call. Period. That's there. And to get started, you can get started, invest now. You can register your account, take a look at the documents, do your due diligence, see what our open fund is, and how you can be invested with us. We really want to be able to help you get invested. That is my mission in life right now, is to help as many people get invested in real estate with us, to help the everyday investor get access to institutional quality assets and democratize how people invest in real estate instead of just relying on the stock market and Wall Street for your retirement later on in the future. I think that's my job. I want to right that wrong in the world, and I think everybody should have access to the same opportunities as the elite, the wealthy, and the deals that we look at are the same deals that they're going after. So, anyways, I hope you guys have a great day today. Let me know if you need anything. I'm here for you. Let's get after it. Boom.